Liberty Holdings released their results today. First half headline earnings were up 18% to just over 440 cents per share. And here to unpack the results is the company's CEO, Bruce Hemphill. Bruce, we initially gave you a very big boost to your headline earnings, quoting 68%, but it's actually come in at 18%. Still looking great on the face of it, but traders at the desk this morning highlighting that it's growth that comes off a very low base. So just how good a first half have you really had?
Look, I think it does. We do come off a low base, but I think it's important to take a step back and look at what we've had to do. The core driver of the turnaround, really two areas of the business. The one being the retail insurance operations in South Africa, and the other being Stanlib. And the core retail operations in South Africa have put in a very good first half performance. I think about it in three stages. We had to fix the balance sheet. We then had to fix the customer experience, or the lapse problem that we've had. We fixed both of those things. The third phase is taking back market share at the right price, and that really is about getting the right sales volumes in at the right margin. And the indications are that we're starting to do that, but you can't declare victory on that piece of it just yet.
Yeah, let's hone in on that. The fact that you've seen a lapse in the rate of your lapse rate, so to speak. I mean,
Sure.
Net customer cash inflows coming in at 1.1 billion rand versus an outflow of 265 million rand last year. And that, you say, as a result of an economic recovery. Does it indicate that we saw stabilization in the jobs market over that period?
No, I mean, I think it might indicate that, but I think in our case, what it does indicate is that in our retail insurance business, we've been very successful in implementing what we call our customer retention program. So we've been able to keep customers on our books.
Yep, but keep them on your books and get them to pay as well. What's your lapse rate standing at right now?
Well, we don't actually declare what the lapse rate is, because it's quite competitive information, which is quite important from a competitive perspective. But it is below the long-term lapse assumption. And we're comfortable that we should be able to maintain it at those levels.
Surely this stands at risk, though, where we've got a worsening jobs picture and overall economic picture coming through. So, just how competitive can you become on that price front moving forward?
Yeah, I think, there are two issues. The one is price and the other is how you defend your book. And we saw in 2008 a significant increase in our lapse rates, which coincided with a significant deterioration in the economic environment. What we've been able to do since then, where we haven't seen a significant improvement in the economic environment, is improve our mechanisms of keeping our customers on the book. So our engagement with agents, our engagement with our customers, and the value that we offer our customers is there. And we've seen that lapse rate stabilize, which indicates that we're in a much better position to keep our customers on the book than we were before.
Let's take a look at new business here. It's managed a slight uptick, from a margin of 1.3% versus 1.1% last year. What's your outlook on that front?
Look, obviously, it's key. the key thing in the margin is the quantum of new business that you're able to generate. As you've seen from the numbers that we showed this morning, it would appear that our new business is tracking in a positive direction. If that continues, and we continue to see the positive lapse experience that we're seeing, then we're comfortable that we should see an improvement in margin.
Let's shift focus to the asset management side of things. We've seen an improvement of assets under management, 385 billion versus 350 billion, and that marking roughly a 10% increase there. Take us through the major drivers behind that increase and what's supportive of that business.
We took a decision last year that we really wanted to drive the establishment of a genuine third-party asset management business in South Africa, and not keep our business as a captive of an insurance company. And to do that, you had to fundamentally change the business. You basically have to give the people who run your business, your fund managers, have to participate in the profits of the business. They have to have an ownership stake in the business, and they have to have autonomy around the decisions that they make. If you provide them with those things, and they believe in the business, and our business is uniquely positioned from a flow perspective, you should over time start to see an improvement in performance, and we expect this business to be a top-performing asset management business in South Africa, and I think we're beginning to see the start of that process.
It's a very volatile period that you've got to wade your way through right now, though. So how do you see the current volatility in South Africa's investment market affecting returns on returns and new business from here on out?
Look, I mean, we clearly are in a very uncertain time. I mean, what's happened in America and what is happening in Europe, creates a very, very difficult backdrop if you're trying to make short-term decisions. We're in the business of making long-term decisions. We think that in time things will normalize. And I think Africa, whilst not completely isolated from what is going on internationally, is probably better positioned than most economies to benefit from higher likely GDP growth rates. And so, you know, we're not changing the way we think about the world because of the short-term volatility. We think that things will normalize.
We'll be getting into your Africa strategy in just a bit, but before we do, here in South Africa, how big a threat are, you know, changes to legislative frameworks? So, you know, the proposed new long-term solvency ratios and a government's benefits product review. What kind of implications do you see that having for the business over the longer term?
Yeah, I mean, the Solvency II regime, which is being implemented in Europe, is going to be implemented in South Africa. It's called SAM, the SAM project. We have been working on this for some time. It's really about how you manage risk. We see ourselves as being in the business of risk. Our job is to identify risk, price that risk correctly, go and fetch that risk, and then manage that risk to get the outcomes we've priced. And that's how we've been running the business. So we think that Solvency II for us, it's not a compliance issue. For us, Solvency II is how do we make our business more competitive? We're a long way down the track to actually embedding a lot of those processes in the business. So we're not worried about it. If we look at the capital ratios, our modeling shows us that from an economic capital perspective, SAM should actually be beneficial to us.
Okay, let's take a look then at that Africa strategy before we go, because many saying that Liberty's been tiptoeing in its approach on the continent. Just how much more of an aggressive approach should we be anticipating moving forward, given Standard Bank's exposure to the continent and the fact that we've had Standard Bank re-emphasize its commitment to Africa specifically?
Yeah, look, we obviously follow Standard Bank, but we must be cognizant of our own issues. We don't just blindly follow Standard Bank. And as you know, we've had issues in South Africa to deal with. I think we've dealt with most of those issues. I think it's important to understand that we've made investments in Africa to the tune of about R500 million already. We've made a very successful acquisition in East Africa, which gives us a presence in Uganda, Kenya, and Tanzania. So we've got a platform there. We've got a big platform in South Africa, and we've bought a business in the healthcare space in Nigeria. So, you know, we're in 14 countries in Africa. We also have a property business which is very active in Africa. So I think to say that we've been timid and tiptoeing around Africa is not true. What we do have to do, however, is make sure that the investments that we've made deliver what we said they would deliver. And I think once we've demonstrated that, we'll have the credibility to go out there and start talking about bigger acquisitions.